For more on this potential new law, joining me here in the studio is Bart Naylor, financial policy advocate and public citizen, and also former chief of investigations for the U.S. Senate Banking Committee. So you've got some experience in dealing with this kind of stuff. Let me first start with this bill, because it's not the first time we've heard about this bill. We've seen others, such as Dodd-Frank. What makes this one different?
This one is different because it substantially raises the amount of shareholder equity that a bank has to deploy in any of its operations. Now the banks, JP Morgan, are deploying roughly 3 or 4% of shareholder equity, along with 96 or 7% of debt. This bill changes that from 3 or 4% to 15%. That's what has to be blown through.
And what does that mean for, I guess, from our viewer's standpoint, they may not fully understand it, but does that mean the banks basically can leverage less?
Well, yes. If you're going to buy a house, they're saying instead of putting 3% down payment, we want a 15% down payment, and you can borrow the rest to buy your house.
And why is this good?
That's because if you only had 3% down payment and somehow the housing market kind of went sour, you might walk away from that. But if you had 15% into it, you're less likely to renege on that loan.
Okay. What's wrong with the banks? I'm just curious. I know it sounds like a silly question, but we've been through it for 5 years. I know they did some bad things. They're now a little better. Well, what have they done that's wrong recently?
They continue to engage in activity that is socially useless, that is to say, the swaps market. We provide taxpayer-backed insurance because we want them to do the hard job of patient loan making to business. JP Morgan has $1.3 trillion in deposits. That's basically free money. And they have only made $900 billion worth of loans. The other 300 or 400 billion they're playing games with. We need them to do what government says, that is to say, make loans, not bets, gambling.
Okay, now I'm going to play the other side here. Sure. Because we don't have the other debater here with you. Yes. So forgive me, but it doesn't make sense to a large extent that the government would control the type of lending or amount of lending that a bank can do. If a bank wants to take risk, yes, why can't they take risk? I mean, a reasonable amount of risk.
Because 2008 demonstrated that in the end, it's American taxpayers that are going to bail them out if they make mistakes. These banks are so large, too big to fail is the dysphemism, meaning they will take risks beyond what a normal company would take because they know that if all things go badly, we will bail them out.
Okay, but aren't they taking less risk today than they were 5 years ago?
No, we saw that the best managed bank in the world a year ago today ran up a derivative bet so bad that it lost $6 billion, almost 10% of its capital, and that was supposedly the best managed bank. Dodd-Frank remains unimplemented largely, and the banks continue to be very risky, continue to do things that are socially unuseful.
Okay. Step back, rest of the world looks at the United States as a example of good things that we've done in the financial system, although it's less likely now. There's a lot of jokes out there that the U.S. financial system is a mess. Are we today healthier than before the financial crisis?
Yes, but by such a small percent that it's almost not worth noting. We've gone from maybe 3.5% of real capital to 4.5%. The banks will dress this up because they play this game called risk weighting, where they disappear some of their assets. For example, they only count Greek debt at 50%, not 100%, whereas they count a loan to Apple Computer, for example, at 100%.
I just wish they'd help me refinance our house. All right, Bart Naylor, thank you very much for helping us understand a somewhat complicated topic, and it continues to drag on. We'll see what happens with legislation. Thank you.
Thank you very much.